Hey everyone, in this video I'm going to highlight one growth stock that's down 89% off its high that you might regret not buying on the dip. That growth stock is Sea Limited. So I'm going to share with you its revenue growth, its operating profitability, cash flow, and valuation as my substantiation for why I think you might regret not buying this growth stock on the dip. So let's get right into it, starting with revenue. And you can see for Sea Limited here, trailing 12-month revenue has exploded nicely from less than a billion around 2017 all the way up to 12.74 billion in the latest trailing 12-month period. Now, growth has slowed down considerably from the boom times of 2019 through about 2022. That being said, the company is still growing the top line, and growth is not as easy to come by anymore since Federal Reserve officials and central banks worldwide have increased interest rates and consumer spending has slowed down as a result of those increased interest rates and a significant decrease in stimulus payments by governments worldwide. Still, despite the slowdown in revenue growth, Sea Limited has done an excellent job in boosting its operating profitability over the years. Starting from the bottom in mid 2018 of negative 100 and close to 150%, the company has done an excellent job in making progress and finally reaching 4.33% positive operating profit margin in its most recent update. Previously, only its gaming segment was profitable, but now all three of its segments are profitable, and so the business is fully supported with profit margins in each of its segments as companies like Sea Limited have focused on profitability, and profitability is more important when interest rates are much higher because the cost of capital is higher. Those losses cost the company much more as investors hold them more accountable during times of higher interest rates, whereas when interest rates are near zero, investors more so encourage companies to sacrifice profitability and go after growth. And so it's a different operating environment, and Sea Limited adjusted very nicely to the change in operating conditions. That also led to a boost in its cash flow from operations. Now, Sea Limited is like so many companies that experienced very volatile times during the pandemic, and then because of the economic reopening, businesses had difficulty adjusting to the rapid changes in consumer behavior caused by the COVID-19 pandemic. It wasn't an easy situation to adjust to, even if you were one of the companies that was benefiting from a burst in consumer demand. It wasn't easy to be ready for that burst in consumer demand and to handle that increase in demand effectively. Thankfully, though, Sea Limited's cash flow from operations jumped back up to 1.35 billion in the most recent trailing 12-month period. And if I compare that with its revenue of 12.174 billion, you'll notice that just about a little over 10% of its revenue turns into cash flow from operations. That's a solid rate, and hopefully the company can continue growing that rate further from here. And the last reason why I'll mention I think you'll regret not buying this growth stock on this dip is because of the relatively cheap valuation. Sea Limited is trading at a forward price to earnings of just 17. That's the lowest this stock has traded for according to this metric dating back to January of 2022. So for all those reasons, I think Sea Limited is one growth stock that's down nearly 90% that you might regret not buying on this dip.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.